savings in order to reach your retirement goals. Maria, back to you.
Mary, thank you so much. If the 401k is back, will the individual investor keep this rally moving? Michael Yoshikami is founder and CEO of Destination Wealth Management. He says this is indeed an indication the retail investor is back in this market. Eric Marshall is Director of Research and Portfolio Manager at Hodges Capital Management. He says the average retail investor is far from jumping back in. Good to see you, gentlemen. Thanks for joining us. Michael, you said the 401k balances show that the individual is returning. How so?
Well, flows are starting to come back into the market, not just on 401ks, but in overall flows into the market. But really, that was a fascinating report about how much people actually need to save. You know, we manage over $1 billion of client monies. We have 8 or 9 certified financial planners. We go through exactly that same process with our clients, and it is astounding how many people have not adequately planned for retirement. That number that was actually just mentioned, how much you need, is probably far short of what you need if what Jim Grantham just said, which is essentially a case for hyperinflation coming down the road, means you're not going to have enough money. So people need to start saving. I think you're starting to see that indication now with 401k balances.
Eric, what do you think? You're not a believer here. You say the retail investor has not gotten back in. Then who is buying? What's driving this rally?
Well, they haven't jumped in with both feet, for sure. I think we've had 5 consecutive years where money has flowed out of equity funds, and we've had, you know, a month and a half where money has come in, but we're still very, very far from the mean reversion. And, you know, at the Hodges Funds, we see the best way to accumulate wealth over time is really by owning a business, and that's really what equity ownership represents. So we think we're still in the very early innings of money coming back into equity markets. And I think one of the key catalysts will be is when you do eventually see interest rates tick up and people wake up and they realize, oh my gosh, I can lose money in a bond fund, you'll start to see a wall of money moving back into the equity market.
You know, that's one of the catalysts.
We're still in the very early stages of that.
Well, yeah, that's one of the catalysts, but I think the biggest catalyst for investors is when they get a 401k statement that's actually invested in equities and they see a balance going up rather than massive volatility on the downside. You know, I also think that what's going to happen is as investors continue to hear from other people they're associated with, as the news starts to tout that the Dow is at 14,000, the Dow is 15,000, it might be 75 or 80% on the upside too late, but that sort of media coverage is what tends to cause money to flow into markets. Now, Maria, you just got done saying that there's still massive amounts of money going into bond funds. That's true, but that's beginning to slow. You're starting to see people put money into emerging markets, U.S. equity assets. That kind of flow is beginning. It's not a two-step all the way in process. It's not an all-the-way-in process yet, but it is starting to happen right now.
Yeah, but isn't some of the 401k growth just a reflection of market performance?
Well, of course, yes. I mean, obviously, it's a matter of flows as well as market performance. But we see this with people that we work with all the time. They have a newfound belief that maybe the equity market isn't going to lose all their money for them. And maybe they'll start to put another 0.5%, another 1%. Another thing, too, Maria, is companies are starting to match again. Many companies actually stopped matching. And when you have a match, even if the employee is putting in whatever they're putting 3% and the match reappears, that's going to increase the flow of money into 401ks as well.
Eric, final word here. Should people have confidence now and contribute more than to the 401k then?
I think that they should. I think that equities are attractive risk reward. We like valuations here. You know, over the last 5 years, there's been over 400 billion leave equity markets. I think if you just get half of that money flowing back in here over the next 2 to 3 years, you're going to see nice moves in stocks. And like I said earlier, I think that owning a business over a long run is really what stocks represent. And that's the best way to accumulate wealth over time.
All right, we'll leave it there. Gentlemen, thank you very much. Appreciate your time tonight, and we'll see you soon. Keep watching that. Really interesting take on that story. Meanwhile, it was Bernie Madoff who drove many small investors out of the market with his historic Ponzi scheme. Madoff